Welcome to the Investing Insights podcast from Morningstar.com. This podcast is brought to you by the Morningstar channel for Roku. Enjoy insightful, independent video content in your living room. Download the Morningstar channel to your Roku today. This week on the podcast, our analysts examined Facebook and McKesson. Michael Kitces talks home loan deductions. We suggest 3 all-in-one funds for hands-off investors. David Kathman says REITs are still attractive. Ben Johnson says capital gains distributions are unlikely for Vanguard ETFs. And IRA expert Ed Slott highlights common IRA mistakes. So let's get started. Here's our take on Facebook and McKesson.
CEO and co-founder of Facebook, Mark Zuckerberg, testified in front of Congress yesterday and answered questions about the latest data breach issue that involved Cambridge Analytica. While this recent development may have brought forth further doubts regarding Facebook and its user growth and engagement, along with more demand for a GDPR type of regulation in the United States, we're still confident that the firm is more likely to endure short-term impact of the data breach issue, and at this point, don't expect a significant long-term negative effect on Facebook's platform and operations. We're sticking with our wide moat rating and $198 fair value estimate for Facebook. Now, Zuckerberg clearly admitted to mistakes and took responsibility. He also said that the firm will be increasing resources to investigate apps and take appropriate actions. Facebook will be using AI technology to identify questionable activities and content posted. The firm also plans to assign around 20,000 people to work on security and content. Zuckerberg also appeared willing to work with lawmakers on possible regulations, which we think may actually create a barrier to entry in the social network space and help Facebook maintain its market leadership. Overall, the testimony didn't really change our view and valuation on the company. We're still rating Facebook as a white moat and valuing it at $198 per share.
Today we're highlighting McKesson. It's one of the most powerful players along the global pharmaceutical supply chain. The company specializes in bringing drugs in from overseas and domestically to the end consumer at retail pharmacies. It can do this at a more efficient pace and a more cost-effective level than many of its clients can on their own. The company has a wide economic moat and has come under pressure here recently because of drug pricing issues and headlines that have put the onus on middlemen who distribute drugs in the U.S. However, we believe many of these concerns and many of these issues are overblown, and McKesson's stalwart position as one of the most powerful players within the pharmaceutical market today positions it well for long term. Combining this with its undervalued stock makes it one of the best ideas here at Morningstar.
Overwhelmed by the market? Morningstar Premium will help you cut through the noise and find the most promising investments. Get started today with Morningstar Premium.
Now, Michael Kitces talks home loan deductions.
Hi, I'm Christine Benz from Morningstar.com. With the new tax laws, there's lots of confusion about the deductibility of home mortgage and home equity loan interest. Joining me to discuss this topic and clear up the confusion is Michael Kitces. He's a financial planning expert. Michael, thank you so much for being here.
Absolutely. Thanks for having me out.
I want to discuss home mortgage interest and the deductibility of mortgage interest and home equity loan deductibility. Let's start with what's changing with the tax laws that are going into effect with the 2018 tax year.
So Tax Cuts and Jobs Act that passed last December made some fairly sudden changes about tax deductibility of mortgage interest. Kicked in immediately for this year, so we're a few months into the year. The rules are already in effect. And at a high level, there were 2 changes. The first is we've had for many, many years a limit that said you can deduct the mortgage interest on the first $1 million worth of debt principal. We're pulling that number down from $1 million down to $750,000. If you have an existing mortgage that was over the $750,000 limit, you could still go up to $1 million. If you refinance an old mortgage that was over the $750,000 limit, you still get to keep it at $1 million. But any new mortgages going forward, actually all the way back to mid-December since the law was passed, we have a debt limit now that's $1 million instead, $750,000 instead of $1 million. The second change that we made is for the deductibility of interest for home equity debt. And the rules, the changes there were a little bit more harsh. It simply says all that interest on home equity indebtedness, no longer deductible. No grandfathering, no like if I had the existing home equity loan, can I still deduct the interest on the payments? Just flat out, effective 2018, no more deductibility for home equity indebtedness. That's gone.
Okay, so there's this concept of home acquisition indebtedness versus home equity indebtedness.
Yes.
Indebtedness. Let's talk about the difference and why it's important. It depends on what you're using the money for.
Yeah, there's been a lot of confusion around this. This difference between money we use to buy our house and home equity loans isn't actually new to Tax Cuts and Jobs Act. We already had a couple of rules around this. The old rules said you could normally deduct mortgage interest up to $1 million. You could deduct home equity loans for $100,000 of debt. There were some special AMT adjustments that applied to the home equity debt, but not the rest of the mortgages. So we've actually had this separation for a while. But the confusion that crops up is it's not actually based on what the bank calls the loan, as though like traditional mortgages are fully deductible, but HELOCs, home equity lines of credit, or home equity loans are not. As far as the tax code is concerned, the deductibility of the mortgage is based on how you use the money. Like literally, what do you do with the proceeds of the mortgage? If you use the money to acquire, build, or substantially improve a primary residence that's secured by that mortgage, like you borrow money against it and you use it to acquire it, build it, or improve it, it's deductible with that used to be million, now $750,000 limit. Any money you borrow against a residence and use for essentially any reason except acquire, build, substantially improve is treated as home equity indebtedness and now is no longer deductible. And so the reason why that distinction matters around use is it means if I take out a HELOC and I use it to build a new room in an addition on my house, that's actually still fully deductible mortgage interest today.
It's a substantial improvement.
It's a substantial improvement. It falls under the 750 category, so I've still got an aggregate debt limit.
Right.
But I've got a $500,000 mortgage already. I do a $50,000 home equity line of credit, and I do it to do a substantial renovation on my home. I've now got a $550,000 mortgage balance. All of that is deductible, even though part of it is a traditional mortgage and part of it is a HELOC, because I used all the money for the categories called acquisition indebtedness, but it's acquire or build or substantially improve. On the flip side, if I take out that HELOC and I use it to send my kids to college, buy a car, refinance some other debt, I don't use it for anything in the acquisition category, now it's not deductible debt. So my HELOC may or may not be deductible, depending on how I use the money. And even my traditional mortgage may or may not be deductible. Classically, when I take out a mortgage, I borrow the money to buy the house. So that's still fine, but we do live in a world where, thankfully, like real estate's appreciating again, at least in most areas. People are building equity. It's not uncommon for people to go and do a cash out refinance. So I've got a 30-year mortgage with $500,000. I do a cash out refinance for $550,000, and then I take the $50,000 and I send my kids to college and do a little bit of credit card refinancing. That $50,000 excess is now home equity indebtedness. It's a traditional 30-year mortgage, but if I didn't use the money for the acquire, build, or substantially improve category, it's now treated as home equity indebtedness, and I literally have like a split loan. The balance is $550,000. I make my monthly payments, but $500,000 of it is acquisition indebtedness. The last $50,000 is non-deductible indebtedness.
Okay. Let's discuss how this should affect how people approach these issues from a practical standpoint. So say someone has home equity debt on their books that they maybe use to pay for college or to pay off credit cards or whatever. Does that mean that they should accelerate the payment of that debt because they're not getting a tax break for that any longer?
So we're not necessarily telling people like, hey, now that your home equity loan isn't deductible, you just got to pay that off and get rid of it.
Right.
Mortgage debt is still a pretty compelling low rate these days, certainly compared to where we've been in the past. But it does mean like we don't look at it and say, hey, well, I'm borrowing at 4, but my tax rate's about 25, so I get the deduction, so the net cost is really 3. It's like, no. If you borrow at 4, your rate's 4. It's not 4 minus a tax break. It's 4. So 4 is not a horrible rate. even plus a little as rates start creeping up. Like I think we'll still see a lot of people that are comfortable keeping the debt. We still have clients that we work with where we're going through the discussion saying, "Great, so this debt isn't deductible anymore," but it's still a compelling rate. We've got cash we're using for other purposes. I'm not going to do a big liquidation of a portfolio just to pay off a loan that's still at 4 because that might be a pretty good rate for them. But it is bringing a fresh look to the conversation when we say, this debt may not be deductible anymore, either a portion of it or all of it, depending on what you've been doing with your borrowing against the house over time. We can't just throw it all in one bucket and say, all that mortgage stuff, we get all these tax breaks with it. It's a much more nuanced question now about whether or how much tax benefit you're actually getting from a mortgage.
Yeah. Another question is, I could see a profile, I think it's common among some of our readers and users, would be the person who's approaching retirement, maybe has some liquidity on hand because they're getting ready to retire. They plan to stay in their home and say they have like $100,000 left on the mortgage. Does this sort of embellish the case for potentially prepaying the mortgage, that they're not necessarily gaining that much from holding on to that debt, and that could improve their overall household balance sheet? Yeah,
it is a conversation now that we've been having more over the first few months of the year. At the end of the day, frankly, we have never been in the camp of saying you should have a mortgage for a tax deduction and doing it for that reason alone. Like at the end of the day, by definition, like the tax deduction is a portion of your interest. You are still paying interest.
Right.
Like they give you a little tax benefit against the interest. 4 minus 1 is a net cost of 3, but like you're still paying 3. If you don't want the debt and you don't want the payments and you're not invested in a way that's beating 3, like you should still pay off the debt. The fact that the rate is 3 is not 3 now, it's 4 because we lose the tax benefit. It's still kind of the same calculus. What else are we doing with the money? Do we have alternatives that are compelling at a higher prospective rate of return than just getting essentially a guaranteed return of 4 by paying off a debt at 4? So for a lot of clients, we're not seeing like, oh, it was a slam dunk to keep my mortgage at 3, but at 4, right. Now it's off. The numbers haven't moved that much just for the change in tax treatment. But yeah, we are seeing more conversations of, we were doing it, maybe tax deduction was at least in the mix as part of the reason why we're doing it, and now the tax deduction isn't on the table, or it's less, or the last 100 is still there and it's technically deductible, but maybe we'll just pay it off and then we'll borrow it back later if we need to, is entering the equation a little more. If I just have a good old traditional amortizing mortgage, I've been paying on it all along, your $100,000 balance is still deductible. Like nothing's actually changed. Right. But people who have borrowed against the house and built up debt over time and added to it now have all these split loans, and that's really where we're seeing the biggest discussion of, do I want to hold on to it? And a tax rate savings on a low interest rate mortgage, usually the tax deduction alone doesn't solely drive the outcome, but it is, I think, making people a little bit more cognizant of, all right, well, if we just take the tax benefit off the table, now, do you really want to actually have this mortgage in retirement or not?
Right.
And taking a fresh look at that.
Right. Another issue is this idea of carrying some home equity line of credit as a source of emergency funding. Yep. In the past, I know that was kind of a standard prescription for homeowners as a way to protect themselves against emergency cash needs. Would you say that's still the case?
Yeah, we're still a fan of keeping home equity lines of credit in place just as something that's available. Again, like it's not like we ever went to someone and said like, hey, you need to borrow some money. You should take it all against your house because you get a little tax deduction.
Right.
Like you take it out because you need to borrow the money for something. And if we need to borrow the money and we don't have a lot of other sources of liquidity, like really thankful we've got that home equity line of credit in place. So that to me is as relevant as ever. We need some emergency funds. It's helpful to have another source of liquidity. Borrowing against equity in a home is a good way to do it. I suspect we may actually use it a little bit less often because the rate's a little bit higher when we don't get the tax benefits associated with it. But the idea of having it available and open, and frankly, like praying we'll never actually need to use it, I think is still as relevant today as it was in the past. When we get to the moment, maybe you'll decide since the interest isn't deductible, you want to go somewhere else. But when our HELOCs are a couple % and our credit cards are in the teens,
right,
tax deduction or not, often still a compelling option to borrow money if we need to borrow money for some purpose.
Okay, lots to talk about here, but it sounds like this is a classic case of not letting the tax tail wag the dog. Put the other considerations first before you consider.
Correct, and we would have argued for doing that in the first place,
Right.
but there's nothing like losing some of the tax breaks to have a little bit of a reminder of let's just recognize that a mortgage first and foremost is a debt with some interest payments. They're relatively low interest payments. There's some nice terms about it. It's not the worst place to borrow if you need to, but it's a debt with interest first and foremost. So does it make sense for that purpose? And then let's see if we get a little bit of tax breaks that go along with it.
Makes sense to me. Michael, thank you so much for being here.
Absolutely. Thank you.
Thanks for watching. I'm Christine Benz for Morningstar.com.
Can your portfolio weather the market? Use our premium portfolio tools to identify risks and streamline your holdings. Get started today with Morningstar Premium.
Next up, these target date series can be a great option.
Target date funds could be a great all-in-one, hands-off option for investors saving for retirement. But not all target date series are created equally. From fees to the mix of asset classes it owns to how that mix changes over time, there could be a lot to consider. We asked our analysts to share 3 of their favorite series.
The BlackRock LifePath Index target date funds are a solid choice for investors looking for an all-in-one solution for their retirement savings. While the funds have only been around since 2011, BlackRock's history with target date funds goes back to the 1990s. And while these funds might be considered passive because they invest in index funds and ETFs, BlackRock has consistently applied a research-driven, proactive approach in designing the glide path and in selecting the underlying asset classes for the funds. For instance, BlackRock has well-documented rationale on their reasoning behind not shifting the portfolios once they hit their target date, as well as behind the decisions to exclude certain asset classes from the underlying mix, such as foreign bonds and high-yield bonds. Plus, the funds come at a low cost, which is appealing for investors, and all in this makes it a good target date series. All these attributes make the BlackRock LifePath Index funds a solid choice for investors.
JP Morgan's Smart Retirement Target Date Series is a top-rated option in our view. In fact, it's the only gold-rated plan that invests exclusively in actively managed underlying funds. We think that the series hits the mark on a number of fronts. First of all, the management team is very tenured, with Ann Lester and Dan Oldroyd serving at the helm since its 2006 inception. They're also supported by a very broad group of more than 80 investment professionals in the multi-asset group. Additionally, their process is strong on a number of fronts. For instance, their strategic asset allocation remains robust and has been consistent over time. The manager selection process is very thoughtful. In fact, they won't hesitate to fire one of their own managers when they deem it's appropriate. Additionally, their tactical allocation process has been in place for over 15 years, and they've proven an ability to add value in the majority of those years. Overall, the fund has actually improved during the last year as it has lowered fees, and some of the underlying funds were upgraded by Morningstar analysts. Performance has been stellar, and overall, we think that the fund will continue to be a great option for investors.
The gold-rated Vanguard Target Retirement Series is an excellent choice for investors, as it provides a well-diversified asset class mix that will help investors reach their long-term retirement goals. While the series glide path hews close to the industry norm, its sub-asset class exposure represents one of the most globally diverse in the industry. International equities accounts for about 40% of the series' underlying equity exposure, while 30% of the bond portfolio is stashed abroad. A lean set of passively managed index strategies makes up the series' underlying components. Strong oversight for the series is provided by Vanguard's Strategic Asset Allocation Committee, which includes senior-level executives at the firm, like Vanguard's chief economist. The committee is responsible for all decisions relating to the series' glide path construction, asset allocation, and underlying fund selection. Finally, low costs here provide an enduring head start against the competition. The series investor share class costs 13 to 15 basis points, which ranks among the cheapest in the industry.
Watch all the Morningstar content you love from your living room. Download the Morningstar Roku channel and get up-to-date independent insights on today's markets. Be comfortable. Be informed.
Now we explain how REITs can be beneficial even as rates go up.
Real estate mutual funds have had a rough time lately. They lost almost 7% on average in the first quarter of 2018, which was one of the worst returns of any Morningstar category. Anticipation of higher interest rates is one big reason for that, since REITs tend to be rate sensitive, and also retail REITs have been hammered by the threat of online retail. This kind of short-term bump in the road isn't a good reason for investors to jump ship, though, because these funds can play an important role in diversifying a portfolio, given that real estate tends not to be very highly correlated with the broader stock or bond markets. They can also be a decent source of income, since REITs have to pay out at least 90% of their profits as dividends. REIT funds as a group have had a lot of ups and downs over the past decade, but the top funds in the category have been pretty consistent and solid. They include T. Rowe Price Real Estate, the one fund in the category with a Morningstar analyst rating of gold, and silver-rated Vanguard Real Estate Index, which is the top passive option.
Go from one investment analyst to 150. Sign up today for Morningstar Premium and let our independent and unbiased research staff help you find the best investments. Get started today with Morningstar Premium.
Next, Ben Johnson explains how Vanguard ETFs are tax efficient.
Hi, I'm Christine Benz from Morningstar.com. Vanguard's equity exchange traded funds have managed to be very tax efficient so far, but will they always be? Joining me to discuss some research on this topic is Ben Johnson. He's Director of Global ETF Research for Morningstar. Ben, thank you so much for being here.
Thanks for having me, Christine.
Ben, before we get into Vanguard specifically and its lineup of ETFs, I'd like to talk about equity exchange-traded funds, why the broad market index trackers tend to be pretty tax-efficient investment vehicles.
Generally speaking, ETFs have two sources that drive their tax advantages. The first is not unique to the ETF structure, and it has to do with the fact that most ETFs track broad-based market capitalization weighted indexes. These indexes will have, say, for example, in the case of a US total stock market index, a run rate of turnover around 3 to 5% per year. This low rate of turnover within the portfolio is really the bedrock of their tax efficiency relative to actively managed mutual funds that might turn over 50, 60, 70% a year.
Okay.
The other source of their tax advantage has to do with the ETF structure. The fact that as ETF shares are created, as ETF shares are redeemed, they take securities from a special breed of market maker called an authorized participant and take into the portfolio, say, the stocks that make up the S&P 500 on an in-kind basis. And when those shares are no longer needed in the marketplace and are ultimately destroyed, those shares are sent back out to that same authorized participant and then sold on the marketplace. So by virtue of purging the portfolio of those shares on an in-kind basis, which I should stress is a feature that's not unique to ETFs, it's just far more commonplace relative to the same practice in traditional mutual funds, you're not unlocking any embedded capital gains that might be present in those securities. So strategy, as represented by broad-based market cap-weighted passive exposure to the market or a slice thereof, and the structural advantage of that in-kind creation and redemption underpin ETF's tax efficiency.
Okay, so that structural setup that you just referenced, that stands in contrast to how it works if I have a traditional mutual fund and I want to sell some shares. Maybe I'm a big investor in that fund. The fund has to send me my cash, and they may have to sell stuff in order to raise the cash to pay me back, right?
That's absolutely right. So more often than not, when a mutual fund faces redemptions, they'll follow exactly those steps by liquidating a portion of the portfolio to meet redemptions. And as has been the case, as we've seen over the course of recent years, as there have been large outflows from many funds, there have been mass liquidations, and the unlocking in what has been, generally speaking, an upward trending market of sizable capital gains that have been distributed to those fund shareholders.
Okay, and we should say before we go any further, if I'm in an IRA or a 401k, this discussion doesn't matter to me.
It means nothing to you. This means something and is very meaningful to investors in a taxable setting.
Okay, so let's talk about Vanguard's setup for its exchange-traded funds. They are share classes of its index funds. Let's talk about that structure and also the implications for tax management of those funds.
So Vanguard's ETF structure is unique in that, as you alluded to, it's a separate share class of their mutual funds. So this has certain benefits to the extent that when the ETFs that are indeed structured in that manner were first launched, they had the benefit of the scale of the existing mutual fund, which was expressed chiefly in a very competitive price tag. They benefit from lower trading costs, given that the overall heft of the portfolio creates greater efficiencies with respect to trading in the securities and just the day-to-day portfolio management function. Now that said, because they're just a separate sleeve, a separate share class of the fund, they will, in the event of any taxable capital gains, take their fair share of those taxable capital gains distributions, which is a risk that is unique to this particular structure that isn't present in the case of standalone ETFs.
Okay, so let's walk through that. Say it's a big index fund, a big Vanguard index fund, and for whatever reason investors begin to redeem heavily the traditional index fund. You're saying because of that setup, even though if I'm situated over here in the ETF share class, that could still affect me.
That could negatively affect ETF shareholders. The bad behavior, say a mass exodus from the Admiral or the investor share class of a Vanguard mutual fund that also has an ETF share class, any gains that are unlocked by that behavior, that selling on behalf of shareholders of the mutual fund share classes, will be shared pro rata with investors in the ETF share class.
Okay, so you did an article on this topic for ETF Investor. Let's talk about how realistic such a scenario is. Should this be something that Vanguard ETF investors should be worried about?
It's something where I will say that in the grand scheme of things, the probability of this risk manifesting is probably quite low. And the magnitude of any negative tax consequences, at least based on many Vanguard funds' historical track record, I would say is quite small. So what would sort of result in such a scenario is really the most important question. And the circumstances that would have to sort of transpire would be large-scale selling in a favorable market environment, such as we're in today. And why are we even talking about this? Because there are some index funds that we've seen over the course of recent years that have seen their shareholder, or their asset bases rather, cut in half by such a mass exodus, by huge outflows in the midst of a bull market. So the portfolio managers can try to do everything in their power to try to shield shareholders, ongoing shareholders, from realizing taxable capital gains. But when your asset base is cut in half, there's only so much you can do. So what is the probability of something similar happening in Vanguard funds? I would say it's really quite low, to be honest. Generally speaking, what we've seen is that Vanguard investors tend to be somewhat better behaved than investors in other fund families. You also have to consider the channels via which their funds are distributed and take into account that in many cases these are funds that are a component of a target date portfolio where we've documented very good behavior on behalf of investors, largely because these portfolios, be they target date portfolios or the individual a la carte index mutual funds, are made available to investors through a defined contribution platform where, generally speaking, we see better behavior than investors in other settings and other channels. So the odds of a mass exodus amongst mutual fund shareholders, I would argue, are probably very low. So thus, I would say that potential for nasty tax surprises for ETF shareholders of those same funds is equally low.
Okay. Ben, you mentioned the in-kind redemption process that's available for ETFs. Does that help mitigate this problem potentially for Vanguard funds, for the ETF share class as well as potentially the traditional index funds?
That absolutely does. So
Absolutely in the case of the ETF share class, but also, as I mentioned before, important to keep in mind that mutual funds can redeem in kind as well. So Vanguard retains the right and has executed the right historically in the case of potentially disruptive redemptions from the mutual fund share classes to meet those redemption requests on an in-kind basis, thus foregoing liquidation, which would potentially unlock capital gains, and thus protecting ongoing shareholders from the negative tax consequences of any such liquidation. So if you take, for example, the case of the Vanguard 500 index ETF and go all the way back to 1999, which is the last time that that particular fund distributed a taxable capital gain, Vanguard exercised that right, did not completely shield shareholders from taxable capital gains, but certainly mitigated the magnitude of that particular distribution, which amounted to less than 1% of the fund's net asset value.
Okay. Now to take a step back, say I'm a taxable investor and I'm really concerned with limiting tax efficiency in my portfolio. How do I make smart choices here in terms of trying to find the investment that's going to do the best job of limiting these taxable capital gains distributions to me?
A lot of it has to do with focusing on the traits that we discussed earlier, looking at turnover and looking at structure. So the ETF structure is really quite powerful, and I think its power to shield investors from negative tax events is actually best demonstrated by the fact that there are a number of ETFs that have had median turnover in excess of 100% now for 5 years running that have yet to distribute a taxable capital gain to investors. So that is the structural advantage of that format on display. Now, if you want to mitigate the risk that's present and unique to the Vanguard structure, or at least just reduce the likelihood of such tax consequences, you can consider an ETF that's a standalone ETF that isn't structured, and all non-Vanguard ETFs are structured as standalone ETFs that sit on their own, that haven't been bolted onto an existing fund. But again, I would stress that both probability and the magnitude of negative tax consequences for investors in Vanguard ETFs is really quite low.
Okay, and a related issue is that if someone is watching this and maybe inclined to say, I'm a little spooked by my Vanguard ETFs, you probably have an embedded gain in that holding anyway, so before you switch into something else, be careful there.
That's absolutely right. And I would stress too that, and we've had conversations about this in the past, is that as this field becomes increasingly competitive, these fears are more often than not being fanned by Vanguard's competitors, right, that are trying to poke holes in their product because their products are so substantially similar in so many different ways that they're splitting hairs that have already been split 2 or 3 times.
Great insight, Ben. Thank you so much for being here.
Thanks for having me.
Thanks for watching. I'm Christine Benz from Morningstar.com.
No matter what part of the market you're targeting, Morningstar Premium Screeners are your shortcut to finding the best investments. Get started today with Morningstar Premium.
And finally, watch out for these mistakes as IRA contribution season winds down.
Hi, I'm Christine Benz from Morningstar.com. Investors have until April 17th to make an IRA contribution for the 2017 tax year. Joining me via Skype to discuss some IRA contribution mistakes to avoid is the IRA expert himself, Ed Slott. Ed, thank you so much for being here.
Great to be here.
So we're hurtling toward this April 17th deadline for IRA contributions for the 2017 tax year. Want to tackle with you, Ed, some contribution mistakes to avoid as the deadline draws close. Let's start with the one that's at the top of the list, this April 17th deadline. It's coming up upon us. What do extensions have to do with this deadline, if anything?
That's the big mistake. Absolutely nothing. It's one of the few areas in the tax code that an extension won't help you. If you have an extension for your regular tax return, there is no extension on the April 17th this year a due date for making an IRA or Roth IRA contribution for the prior year, being 2017. So this April 17th, whether you're on extension or not, is the drop-dead due date for making an IRA or Roth contribution for 2017.
Okay, so time's a wasting on that one. Another thing you say that people sometimes get confused about is needing to have earned income in order to make an IRA contribution. Let's talk about that one.
Well, yeah, people think you can just put anything in a Roth IRA or IRA. There are qualifying factors, and one of them is you need earned income. Now, earned income can be wages or self-employment, and some people don't know this, but it could also be alimony. Believe it or not, taxable alimony counts as earned income, and the old joke is, who said I didn't earn it?
Okay, let's talk about the fork in the road that a lot of investors hit where they can make either a traditional IRA contribution or a Roth IRA contribution. Making the wrong contribution type can also be a stumbling block for some investors looking to fund an IRA. Can you offer any tips there? Talk about how people can go wrong when they're making contributions to an IRA?
Well, each one, it's odd because the two different IRAs have almost totally opposite rules. For example, for a traditional IRA, there's an age limit. After you're 70 and a half, you can no longer contribute. Even if you have the earned income, you can no longer contribute to a traditional IRA for the year you turn age 70 and a half and future years. For Roth, there is no age limit. You can contribute to a Roth as long as you have the income of forever if you're 90 years old. Now there's income, earned income, and then there's income tests. An IRA, a traditional IRA, has no income tests. You could make $1 billion and still contribute to a traditional IRA. With a Roth, there are income limits. Now, they're pretty high, so most workers are able to do it, but that's another difference. So you have differences in qualifications and differences in what's best for you. For example, and by the way, back on that other one, I know some people will pick up, I said there's no income limits for making a contribution to a traditional IRA. They might say, but yes, there are. Only if you want to deduct it and you're active in a company plan, then there are income limits. But to do a non-deductible traditional IRA, there are no income limits. So then there's the decision, should I do a traditional or a Roth? And generally, I'm a big Roth IRA fan because I don't think the deduction is worth all that much unless you're in a very tax bracket. But even so, you might get a deduction at a high tax bracket this year, even using the 2017 higher rates. But then all the earnings will be taxable forever at one point when you pull it out, as opposed to a Roth, you give up the tax deduction, but all the earnings accrue tax-free forever. So that's a choice. I kind of like having tax-free income in retirement, so I like the Roth IRA. But some people can't do a Roth IRA because they're over those high income limits I talked about.
Okay, so in any case...
But that leads us to probably the next point.
Well, yeah, and in any case, investors need to mind those income limits and spend a little bit of time thinking about what is the right IRA type for them. And for people who are shut out of deductible traditional IRA contributions or Roth IRA contributions, one strategy that has become really popular is this backdoor Roth IRA. Let's talk about that and talk about how investors can stub their toe a little bit, especially if they have other IRA assets that might be sitting around. How can they inadvertently get themselves into a little bit of a tax pickle?
Well, first, we're only talking about Roth IRAs because that's the IRA that has the contribution limits, the income limits, those high income limits. And we're talking only about, when we say Roth, you got to be clear, we're talking about contributions, not conversions. Conversions, there are no income limits. So we're talking about the $5,500 a year, or if you're 50 or over, the $6,500. And that's another point. Some people forget about the catch-up contribution, that extra $1,000. And so let's say you're over the income limit, say you're around 200,000 of income and you're over the income limit, so you can't qualify for the 5,500 or 6,500 Roth IRA contribution. There's something that's been so-called the backdoor Roth IRA. And what that is, as I told you earlier, there are no income limits like that on a traditional IRA. So you could make a non-deductible traditional IRA, as long, again, you have the earnings, and convert it to a Roth IRA. Now, in prior years, people questioned, was that a legal strategy? And nobody really knew the answer. But now we do know the answer, because in the conference committee report of the new tax law, the Tax Cuts and Jobs Act, Congress actually said in 4 places that that is an allowable strategy. So there's no problem there. All right, so what you have to do, you still have four different cautions. So the idea is you make a non-deductible contribution to a traditional IRA. That's where it starts, and then you convert to a Roth IRA. So there's 4 cautions, I call them. First, the age. Remember I said traditional IRA contributions have an age test. So if you're over 70 and a half, this strategy won't work with you, because the whole strategy starts with making a contribution to a traditional IRA. If you're 75, you can't do that. So that won't work. You have to have the income. Even though you're making a traditional IRA non-deductible contribution, you still have to qualify as having earned income to be able to do that. But there is a loophole. Even if you don't have earned income, if you file a joint return with a spouse who does have earned income, you can qualify on his or her as a spousal IRA. So you're okay there. But you have to have earned income. And then the rule you're talking about is if you have other IRAs. So people tell you sometimes you make this contribution to a non-deductible IRA, and then you convert it tax-free to a Roth IRA. Well, if you have other IRAs, traditional IRAs, pre-tax money, you have to figure that into the mix. It's a so-called pro rata rule, a proportionate rule. So it means if you have a lot of other IRAs, chances are maybe 90% of the conversion to the Roth could be taxable. It may not be tax-free if you have other IRAs. So just be aware of that. I don't think it's a big deal, because you're only talking about the tax on maybe part of the 5,500 or 6,500. The other caution is, the last caution is, it goes in as a conversion, not a Roth contribution. We call it a backdoor Roth contribution, but really the way the money gets to the Roth is through a conversion, not a contribution. Now that makes no difference if you've had a Roth for 5 years and you're over 59 and a half. Then whatever you pull out is tax-free. But if you ever need to get to your Roth money early, the fact that it goes in as a conversion, you have to hold that money for 5 years and 59 and a half. As opposed to a contribution, if it was a straight Roth contribution, Roth contributions can be withdrawn at any time for any reason, tax and penalty free. But this is not going in as a contribution, it's going in as a conversion. But the best advice, if you're doing a Roth, you're doing it for the long term. You shouldn't be looking at taking it out early. The power of the Roth is the decades of tax-free compounding. That's where you really make your money. So if the point is to hold it for the 5 years and you're 59 and a half, that's where you'll do better, and then that's not an issue.
Okay, so some important things to know if people are considering embarking upon this backdoor Roth IRA maneuver. One other point you make is, and a place where people can sometimes drop the ball, is that they do need to file an additional piece of paperwork if they're doing this this backdoor Roth IRA contribution and conversion. This is a Form 8606. Tell us what we need to know about that one.
Yeah, it's a separate form. It's attached to your tax return. You have to file it anytime you do a Roth conversion. So that's a Roth conversion. That has to be filed. And that's the form that figures, and you don't have to figure it. It does that pro rata calculation automatically through the computer, as most people do it. So it will tell you how much of that 5,500 or 6,500 will be taxable. So the form goes through that calculation. So that will help you there to make sure you're you're showing the right amount as taxable.
Okay, Ed, as IRA contribution season winds down, thank you so much for being with us to share these tips.
Great to be with you again, Christine. Thank you very much.
Thanks for watching. I'm Christine Benz from Morningstar.com.
That does it for this week's Investing Insights podcast from Morningstar.com. We hope you have enjoyed our program, and we welcome your feedback. Please send your comments and questions to podcast@morningstar.com. From everyone here at Morningstar, thanks for listening.